Hello, everyone. Welcome to another Hot Forex webinar. Can you all hear me correctly? So just give me a yes in the question box if you can. Okay, thank you guys. Thank you very much. So as I've said, welcome again to another Hot Forex webinar. I am Nektarios and today we'll go through why inflation is important for forex market. So thank you all for replying that you can see me well. So given that most people say that I come out quite decently, so if you have any audio or video issues, so please check the settings on your computer. Let us know through the chat window, so I may do something wrong here. Something can come up unexpectedly. So if you see any weird things happening, just let me know. Okay. So in addition, if you've got any questions after the webinar, or if you've got any potential longer questions that you would like to discuss, don't hesitate to send us an email at webinars@hotforex.com, and either myself, Andrea, or Stuart will get back to you. A short introduction about myself. I have been at the Bank of Cyprus for more than 4 years, where I have actually got hands-on experience with real-life economics. And my approach to trading is a balance between science and art. When I mean science, I do mean everything related to either economics or any sort of estimation or modeling. I have a PhD in financial economics, and I have done research covering lots of issues such as stock markets, trade balances, and economic policy. To reply to Alexandre, yes, the webinar is going to be recorded, and as usual, by the end of this session, you will receive an email linking you to the website where we have uploaded the video basically. So again, remember that this material is provided as general marketing communication for information purposes and does not constitute independent investment research. So nothing in this communication contains or should be considered as investment advice or investment recommendation as to the purpose of buying or selling any financial instruments. So what we're gonna do here is that we're gonna see an education on we're gonna get some intuition as to how inflation affects the FX rate. So we will start with what is inflation. So we talk about inflation, but we really need to be to have in our minds what exactly this means. Then we're gonna see what affects the inflation. We're gonna have a look at how this what are the main sources that impact inflation essentially. Then we're gonna see the important part after we understand what inflation is and what affects inflation. We'll see how inflation affects exchange rates, and then we're gonna see we're gonna have a Q&A answer. Okay, so let's start with the definition. So what is inflation? Inflation, the definition of inflation is that is a change in the price level of a country. Okay, so what do we mean when we say at the price level of a country? So in essence, what statistical agencies do is that they create a basket of the most commonly bought goods. So you can imagine there is bread, there is milk, there is vegetables, there is other basic goods. So food and groceries are all in there. Others may the basket can include oil. It can include lots of other stuff. So this particular basket of goods is monitored through time. So basically what we do is that we monitor the price of milk, for example, through a long period of time. Okay, this is usually conducted on a monthly basis. You do realize that it doesn't make sense to observe the price of milk or bread or the price of potatoes and tomatoes each day. So we do this on a monthly basis. Sifmandia, if you cannot hear anything, your audio has a problem, then you should try to look around your computer settings. You should be able to fix it. Okay, if everyone else hears me, then try and fix the audio on your PC. Try and have a look what goes on. So, as we were saying, this basket essentially says that we measure the most commonly bought goods and services in the economy. Okay, so what we do is we track around is that the statistical agency of each country tracks which of these goods are traded, and they monitor their prices. So as I've said before, we monitor the price of bread each month. They monitor the price of milk each month, and so on. Now, this basket is essentially weighted. So essentially consider this basket as an average. All right. Okay. So what they do is that they measure each price and they compare it to the previous month. So they say, okay, milk has increased by 2%. The price of bread has decreased by 1%. The price of potatoes has also decreased, and so on and so forth. Okay. So what they do is they make an average of these things. So they say that they create an average for the basket, and then they comment, okay, on average, the basket has increased by, say, 1% or 2%, or has decreased by 1 or 2 or 0.5 or whatever. So this collective basket is converted then to an index. So what they do really is that they set a specific period to 100, and then they start multiplying or deducting with the percentage change in each month. So this is called the consumer price index. Okay, and the change, as what we said, the average change in this basket of goods is referred to as the inflation rate. Okay, so given that what we've seen is that we collect information about a lot of goods and then we average them out, then it is easy to understand that inflation should be interpreted as the average growth of prices in the whole economy. Remember that inflation again is the average rate of growth in the economy. So inflation does not specifically dictate that interest rate that the price of bread has increased by 2%. It says that on average, over all goods, we have observed a 2% increase. So the price of bread may have increased, may have decreased, or may have remained irrelevant. However, given that we do not really care about every specific good, what we care about is the overall price level of the economy. So if just one good has increased, then it maybe have something to do, say, with the weather or stuff like that. But if the whole of the economy increases by that much, then what we're saying is that, okay, this has some underlying causes. Okay, so what we're seeing is that what we're getting at is what causes this inflation, right? So we see that we can observe a change in the price level, and we can observe that this price level moves from 1% to a 2% growth. Okay, so every price in the economy increases by an average of 2%. Excuse me. So what causes this effect, this impact? So what affects inflation? As expected, this has to do with the forces of supply and demand. Okay, so in this case, demand is referred to as a demand pull effect, given that higher demand pulls prices higher. So if we have more demand for the goods, then it means that the prices will increase. Okay, so think of it as consumers trying to pull the price up because of increased spending. Okay, so the more money consumers have, the more they will spend on goods, and then this will have an impact on the price, right? So you can imagine that if I have a specific type of good, so say I have a glass of water and I'm selling it for $1. So if I have just 2 or 3 buyers, then the price is going to be more or less like that. But if I have 100 people that are willing to buy this glass of water, then I may actually be able to sell it at a higher price. Okay, so this is the case for demand. So in essence, higher demand, more people willing to buy it, pulls the price of the good higher. Okay, so what are we saying? So imagine that now we have the same 100 people that want to buy my glass of water. Now, if each of these guys had just $1, would that make an impact on my price of selling the glass? No, because I am selling it for $1. Everybody has $1 with them, and so we're all happy. Now, suppose that someone came and said, you know what? We don't have $1 anymore. We have $2. So what's going to happen? Well, these guys can now spend more money to get the glass of water I'm selling. Okay. So what happened is that consumer purchasing power as a whole has been increased. And I do mean as a whole. So if just one guy purchases my glass of water, then he has $2 and everyone else has $1. Now, this guy has actually made very little difference to my company. The reason is that only this guy can buy it for $2. So I will sell it just once at a higher price, and then to everyone else, I will be selling it for $1. So no big change has happened. So what really needs to take place is that the total amount of money in the economy needs to change, not just people, not just one person getting richer. So you can imagine that if we have one guy who is super rich and everyone else is very poor, then it doesn't mean that the overall price, the overall level of inflation will increase, because this is just one guy. Now, there are 4 different possibilities of affecting inflation. The first possibility is that people collectively increase or decrease their savings. So what does that mean? Now everybody makes some wages. Well, at least most of us. So what people usually do is that they put aside a percentage of their savings, or of their wage as savings, for a rainy day. So this can be either 2% or 5% or 50% or whatever. This savings percentage, however, is not very stable across time, for reasons that have to do with perceptions, availability of money, and so on. So basically, what we're saying is that if people feel that they have more money, their prospects are more stable, they see that banks are granting loans very easily, then it's very easy for them to decrease their savings. So they're saying, okay, I may need more in the future, but at this point in time, I'm very happy with saving less. So have a look at the blue line here, as you may see. So you can see that the savings rate has actually been going down until 2008, after which point it actually increased. But you can see that it has made a big difference. So it has been going up and down, and as you can see, it usually spikes up during recessions. Okay, so Sivmantia, I'm not sure that I have muted you actually, because I don't think I can do that. But I do have you registered twice, so if you can, it would be better if you got out of both and then try to rejoin if you can do that. Okay, because I have you twice there, and this is maybe why this is an issue. Okay, so I cannot actually mute anyone here. Okay, so as you can see now, this graph shows that the savings actually reached 12% in 1955, and they were actually at a low of almost 2.5% in 2005. Now, it's a very simple exercise. If you save 10% of your money, then you're essentially spending 90% of your money. But if you're saving only 2% of your money, then you're spending 98% of your money. So what this means is that the savings rate is going to be a crucial determinant of the inflation rate. So the less money people save, the more spending there is in the economy. So demand gets higher. If demand gets higher, then we all know that this means that inflation will also get higher. Now, of course, other factors will also play a role. Still, the red line, which is the consumer price index for the United States, has a very, very strong correlation. Correlation, I remind you that it's essentially a measure of how well together people move. Okay, no, not just people. Sorry, I mean the economic series and other variables. So what this is saying is that the correlation between the blue line and the red line is actually an impressive 80%. So 80% of the change in one variable can also be explained by the change in the other variable. So savings is quite important. Now, moving on to the second possibility of affecting inflation is that boils down to the government. Now, the government spending was a big debate back in the 1970s and 80s, and it was for once considered to be the greatest factor affecting inflation. Okay, so what's the idea? Suppose that a government decides that building a new road would increase the citizens' well-being. So this construction would come in addition to the usual expenses in the country's budget. So what this means is that consumption will essentially, government consumption will essentially increase. Okay. then what happens? Suppose someone has to build this road. So the government makes a very nice project and assigns it to construction company A. So what this means is that given that construction company A has assumed the role of building this this road, it will have more profits during that year, right? So what would happen is that really the construction pie has not decreased. It has or it has not, or company A has not actually gotten profits away from other people in that business. It's just that the pie has increased. Okay, so the other companies are not adversely affected. So what happens really is that company A has observed more profits during the year and has actually seen an increase in this in its budget. Okay, so what happens overall is that money circulating in the economy will increase, right? So if that company makes more profits, then it would mean that most likely its employees will gain more money, and it will distribute a larger amount of money to its shareholders. So overall, money in the economy will increase. Still, the government, in order to finance this project, has to borrow some money. So how does that work? So governments issue bonds, right? So you can see them in MT4 where we have the bond trading. So what happens is that they borrow money from the public. When we say public, we don't mean just everyday persons like me and you guys, but what we mean is that people like banks and hedge funds and large institutional investors. Okay, so how do banks invest? Banks essentially use the money they are not currently employing as loans. So basically, they're using your savings to invest them in government bonds. So you can see how this works with the connection of between savings and with the question between savings and government spending as well as inflation. So if the construction of this new road is completed, is mandated by the government, then this would mean that we increase the amount of money in the economy. So how do we get money for this? Then what we do is that we are facing different a different point of getting the money. So how are we going to get that money? We're going to get that through the banks. Okay, so what happens is that the overall money which circulates in the economy will increase. So the idea is that government, in order to do something meaningful for the people, needs to borrow some money and needs to spend that money. The issue is not very difficult, actually. So this means that the government will have somehow, though, need to repay this bond, right? So it will borrow money from the bank, but it will need to give it back to the bank in order when the time is due. So this means that it would either have to increase taxation or decrease spending. However, by the time this is needed, then we do not really have to, we may not really see the effect of this happening. So if the new road actually has a strong impact on the economy and boosts trade, then this would mean that we would have to either try to increase our taxation or decrease the money government spends. Okay, so this is the main idea. In addition, think about that as we've said, if this has a very positive effect, then this reduction in government spending or a small increase in taxation will not have any strong impact on the economy and inflation. Now, the third possibility is that commercial banks increase or decrease lending. So think of it very simply. If one of us goes to the bank and says, you know what, I want to buy a house that costs $400,000, but I don't really have that money right now. I only have a percentage of it. So what the bank does is that it says, you know what, no problem, we will do that. I will lend you that money, and you can repay me back in time. So as you can imagine, banks create this money and increase demand by handing out loans to the people. So this is a third possibility. What banks do really is that they increase our purchasing power, right? So we're able to purchase more than we would have been. So this happens, and we are able to increase our purchasing power and hence increase the amount of money in the economy and subsequently the inflation rate. Okay, if you've got any questions on what I'm saying, feel free to write me questions. I will reply as soon as I see it. Sifamandla, I'm sorry, but I can't do anything. I am not muting you, so muting you has nothing to do with the fact that you cannot hear me. That's a bit odd. Then the fourth possibility is that the central bank decides to issue more money. So if the central bank wants to print more money and give it to the public, or what usually happens is printing new money and financing government spending, it would mean that the government would not have to borrow from commercial banks, but it could get this fresh money directly from the central bank. So instead of getting people's savings, then you would actually be getting the central bank's newly printed money. Okay, so this is what quantitative easing, QE. I'm sure you've heard it a lot. So this is what it does really. So the central bank issues money and purchases government bonds. So when we say issues money, it doesn't mean actually printing money. It doesn't go with a large stack of dollars and buys government bonds. It's really a creation of money. So we're living in an electronic money era. So what happens is that we buy and then we sell. We sell it the central bank gives it to the public sector, to the government essentially. Okay, so imagine the issue here is that if the government does this, then if the central bank decides to issue money and buy government bonds, then it would mean that the government needs to spend that money in order for the money to reach the economy. Otherwise, it won't be able to reach it. Okay, so let's go to the supply side. So just put something in your minds. Just think about something. When we're saying we're talking about the demand side of inflation, what we're saying is that we observe an increase in the amount of money in the economy. We're seeing an increase in the purchasing power of money, right? In the purchasing power of consumers. So is this good or bad for the economy? I'm not going to ask for the currency yet. We're not there yet. But think about it. What we're saying is that we observe inflation when we see an increase in spending, when we see loans growing, when we see the government spending more money, and when we see the central bank issuing more money. So is the increase in money good or bad for the economy? Naturally, we're talking about usual standards here, right? We're not talking about overprinting money. We're not talking about over lending. We're talking about normal lending practices. We're talking about normal spending by the government. We're talking about good investment. We're talking about an increase in the economy. So I got three answers. Bruce corrected himself and went from bad to good, and Alexandre again said this is good. So you both guys are correct. This is good for the economy. So is Carlos, so is Lionel. Very good, guys, very good. So this is good for the economy, right? So what we're seeing here is that an increase in inflation is this type of increase in inflation is characterized by the fact that good things are happening in the economy. We're not observing bad deterioration. We're not observing any bad things. So what we're seeing is that the economy is growing. We have a very strong credits. We have good credit growth. We've got good spending. We've got good savings, and we're not seeing an over spending. So yes, as Edward comments, this is a normal economy. So you're right. Good that everyone's with me. So let's continue now. Let's move to the supply side now. So supply is called a cost push inflation. What does this mean? It essentially means that the supply side relates to an increase in costs. An increase in costs means that we're pushing inflation higher. Okay? So what we are talking about is that producers increasing prices because of shocks that have increased production costs. Okay? So this usually happens for goods or services for which no close alternative exists at that point in time. So the most straightforward effect is of the most straightforward cause of a supply shock is the price of oil. So an unexpected increase in the price of oil would drive up prices for goods which are highly dependent on oil for production. So you can imagine that if we see a doubling in the price of oil, then we would see a doubling in the price of plastics, right? So businesses do not really want to increase their prices at this point in time. They're just forced to do this because the price of oil has increased. Okay, this is the main idea. Another point is wages. However, wages is a bit tricky. So wages can increase for two reasons. First, we can see that either wages increase because prices have increased. So for example, if you're seeing that everything in the economy has been getting more expensive because we have strong growth, then what you're going to say is that, boss, I want a raise. I cannot really go on with this. I need some more money to be able to maintain my standard of living. So this is not the type of cost that causes that is a direct impact from a supply cost. So this is really an outcome of the demand side, the one that we've seen before. Now, if on the other hand we see that the price of we see that wages increase for no apparent reason, so basically suppose that a large part of the workforce is unionized, and unions decide that they want to see an increase in wages by 5% instead of a 2% inflation rate. Okay, so I'm not saying that unions do this. I'm just commenting that this is an example. Okay, so if they do this, then it would mean that the cost actually outweighs the benefit from the higher price that businesses can obtain. So this is the issue here. What we're observing is that an increase in spending, an increase in wages can come as either from demand or from the supply side. So now I'll ask you the same question I asked about the demand side. Do you think an increase in the cost of production is a good thing or a bad thing for the economy? Note again that this can happen for two different reasons. So remember that it can be because the price of oil has increased and that has thus forced people to increase their prices, or it can happen because, say, unions demand much higher wages than they are justified. So what do you guys think? Is this good or bad for the economy? Already got 2 answers. Come on, guys. 3 answers. Come on. Think. Give me an answer. This is an important distinction because when we see how it affects exchange rates, we'll have to understand whether it's bad or good. So there you go. Most of you guys got it correct. So this is not good. It's quite bad, really, because when we're forcing people to increase their prices without them wanting to, it means that we're making everyone worse off. So what we're suggesting is that people do not really want to raise their prices. That's an important distinction. They do not see an increase in demand. They do not see anything good. They see that they are forced to make this increase in prices, and this is what makes things bad. Okay, is this clear now for everyone? If not, just send me a question. I'll be happy to reply. So thank you, Bruce. So how does inflation affect exchange rates? So as we've said before, exchange rates are affected by factors which move supply and demand for the specific currency. So we have thus far distinguished between supply side and demand side inflation. Okay. However, there have not been many supply shocks, at least in the last few years. I mean, there have been very little supply shocks in the world over the past years, and the price of oil has actually been trading around $70 since 2006. As you can see now, it has actually decreased. The oil price has been in bear territory, and in the US, supply shocks to inflation are strictly domestic. So what we're saying is that these shocks are not affecting consumer spending. So when I'm saying supply shocks are fully domestic, I mean what we said before about wages. So what this is saying is that prices tend to increase. So if wages increase, for example, then this will be even out. So if wages increase, then people will have more money, right? So they will spend more money. So this will, in its turn, increase prices. So if this happens within an economy, then people are happy. Even producers are happy because they know that I am increasing prices, but I'm going to get that money back because people are going to spend more. Exactly because I have increased prices. They're not sending people in. They're not sending money abroad. They're just saying that, you know what, I will be sending. I will be spending more money given that I have increased my wages. Okay. So any change in prices, even from the supply side, will be related to the growth of the economy. So remember that demand side inflation is always good for the currency and suggests that the economy is growing. Economic growth is always positive for the currency. A stronger economy always is always positive for the currency. Okay, so what happens here? So you can see my graphs, right? So what we're saying, I have 4 different charts. So I've got, these charts are from August, but it's just the same in every case. So let's see now. The graph here with the euro dollar. Let's start with this one. So this was August 10th, 2018. The consumer price of the US comes out 2.4% against expectations of 2.3%. So the US dollar actually appreciates 20 pips. You can see that the movement here going down. You can see the movement here. This was the announcement, and you can see that this is going down from here. Okay. Then let's move to the Canadian. So what happens here is the Bank of Canada CPI measures the inflation rate. So this inflation rate came out 0.5% higher than the expectation. So what happens here? We see an approximately 75 pip change with respect to the dollar, and actually maintained that reduction. Okay, so this is a very, very strong movement against very strong inflation data. So let's move here now. This is the Japanese yen. This is a dollar yen exchange rate. So what happens here is that the Japanese inflation rate came out at 1.2% compared to expectations of 0.8%. What happens is that the dollar declined and the yen increased by 12 pips and actually continued this movement here until the following day. So finally, let's see what happened. Let's see what happens when an inflation announcement is worse than expected. So in this case here, the euro-dollar rate went down because the euro area inflation rate came out actually lower than expected. Okay, so in this case, this rate here ended up hurting the euro exchange rate. Okay, so now let's see what happens here. Latest news show that Turkey's inflation stood at 24.5% year on year compared to what was, just in huge quotation marks, 17.9%. Now what happened is that the lira on the day depreciated by 500 pips, guys. 500 pips. You can imagine how big this movement is. We don't see these movements very often. So what caused this reaction? Why was Turkey's inflation rate different than the inflation rate in the euro area and the inflation rate in Canada and the inflation rate in the US? The reason was that Turkey's inflation did not arise from growth, but it arose from a 25% depreciation in the Turkish lira. Okay, so as the lira depreciated, this is likely to have caused a severe increase in the cost of imported goods. Okay, so what this means is that anything that comes into Turkey from outside is going to be much more expensive. So what this means, producers are going to be exactly, Alexander, less purchasing power. Why? Because producers are going to be forced to increase their prices. They're going to be forced to increase their prices not because they want to. They're going to be forced because their cost of making the goods goes up. Okay? So you can imagine that this is a very, very strong implication. Okay? So this can actually be even worse if at that time oil prices were increasing. So you can imagine the combination of rising oil prices and a depreciating currency. Okay, so it means that the price of oil is going to skyrocket for the economy, for that economy. Okay, so what is this? This is what I have described before. So this huge spike here is this 500 pip change in the price of drop in the exchange rate of the lira. Notice that I have only counted the open and close prices. I have not included the full range of the lira. If I included this, then it would mean that it would go actually higher than 1,000 pips. Okay, so you can imagine how strong this movement is. Okay, and how important inflation is for the markets. So how do we know what causes inflation? Well, we have to be observant. We need to pay attention to the data. So if inflation changes by more or less in accordance to the change in bank lending and government spending, then we can gauge that this is caused by demand factors, right? So if we see that government is more or less spending the same each quarter, banks are again more or less spending, giving the same amount of loans, and inflation is between these numbers, we of course need to check about savings, and we need to check if the central bank is printing money. But here's a tip: central banks do not usually print more money unless we're observing a crisis. So you can tick that one out. So all we have is three possible explanations. One is the savings rate, two is the bank lending, and three is the government spending. So if this thing can be gauged, if the inflation rate is more or less in line, so we're not talking precise numbers here, guys, but if we're seeing that this is in line with what's happening, then we can agree that this is caused by demand factors. Now, if inflation increases by much more than these indicators would have implied, and in addition, the exchange rate is declining or wages are increasing by much, or we observe that there is a huge spike in the price of oil or something like that, then we need to worry, because this happens because we have been observing an increase in inflation caused by the supply side, and this should have an important bearing on the currency as well as the economy of the country. So in a nutshell, remember that we have two types of inflation. We have inflation which is caused by demand factors, and the inflation which is called by supply factors. In addition, we have a separation between the two, because the demand factors are usually good for the economy, while the supply factors are usually bad for the economy. Okay, so we need to pay good attention on which causes what. Okay, now I've more or less completed what I wanted to say, so please ask me anything. Ask me anything you didn't understand. Ask me anything that you had in mind and you wanted to elaborate. So feel free to ask me whatever you want here, guys. It's your time now. You get to ask the questions. So if you're not gonna ask the questions, let me ask some just to see how well you understood the material. Okay, thank you, Alexander, for your kind words. But let's there's how can I benefit from inflation? Well, you can benefit from inflation by making a correct forecast. Okay, so if you make a correct forecast, which means that you can understand where inflation is going, you can have a good idea of where this is going, then you can test this on the FX market. So if you expect that inflation will increase, then you also expect that that prices will go up, and you will be able to benefit from this. Sivmandla, you're asking, I missed out what causes the inflation rate, I presume you want to ask, to increase or decrease. As I've said before, this is there are four factors that cause it from the demand side, and on the supply side there are some other factors. So I remind you again, from the demand side, this is the savings rate, the bank lending growth, government spending, and money printing by the central bank. From the supply side, you have external shocks such as increase in the price of oil and so on. Okay, so what would happen to US dollar when US inflation increases? That's a good question. What do you think it would happen, Lionel? Oh, I'm getting many questions now. Wait. So let's answer Lionel's question first. What would happen to the US dollar when the inflation in the US increases? What do you think is going to happen, guys? So think, if the US dollar, if the US inflation, okay, guys, lots of questions. If US inflation increases, but increases exactly at the forecasted level, then we do not expect the US dollar to increase. But if US inflation increases, and this is caused by demand side inflation, and this increases by more than the projections, we expect that the US dollar will go up. Okay, this is the answer to Lionel's question. How do we know if it's demand or supply inflation? From the economic calendar. So the economic calendar can give you lots of information about data which arise. So it can give you lending, it can give you government spending, it can give you loads of data analysis. So you can see and examine for yourself. So if you see that bank lending has been increasing and government spending has been increasing as well, then you would expect that inflation will come out higher. And to that end, you expect that you can get this data from the economic calendar. Sorry for that. When an inflation release is published on a currency and the actual is greater than the forecast, does it mean that the price of the currency across the board would go up? So Richard, in general, yes, but only if this is driven by demand, not if it's driven by supply. So remember the Turkey example before. Turkey's inflation went up because of the deterioration in the lira. So this was a supply factor, not a demand factor, okay? The price of some currency can increase the inflation level in in a country. Yes, it can. So this is exactly what happened with Turkey. So suppose that the currency deteriorates by 10%, then it would mean that everything you buy from abroad will be more expensive by 10%. Okay. So if this happens, then it means that we have less spending power, we have less money, we have our money buys less good. So what will happen is that inflation will go up, but because of supply side. Okay, so this is the bad type of inflation we were talking about before. Okay, so how to trade the news inflation, how to trade the news of inflation, you mean? So basically this is, as I've said before, if you believe that the inflation is going to be higher than the projected and you have good reasons to base this upon, okay, you can bet that the announcement, the actual data is going to be higher than the projection. However, note that if it's lower than the projection, you may end up with a loss. Okay, so you need to be very careful. How do we know the difference between the new inflation and the older inflation to determine the average? What do you mean new inflation and older inflation? So it's new inflation and forecasts, Clinton, if this is what you're asking me. So we have a lot of forecasts from economic analysts who say that, we expect that we're going to have this effect. And this is a forecast. So if the forecast is usually built in the prices, so markets adjust for this forecast. But if the actual comes different from the forecast, then the markets have to readjust. Okay. If this is what you wanted me to answer, Clinton. If not, please rephrase your question. Sifmandia. Yeah, most important points on the topic is ones that I have commented before as well. So you can actually watch the video again. It would be a good idea to get a better understanding of how inflation works. So remember, we have two types of inflation: supply side, demand side, and these affect the currency in a much different way. Okay. So how do we find out the type of inflation on the FX news, whether it's demand side or supply side? So this is what I've said. So you need to keep an eye on the country, Caleb. What I mean, keep an eye on the country. You need to observe. So, for example, is the price of oil rapidly going up? Is the exchange rate rapidly going down? Are we seeing any deterioration in the prospects of the country? Are we seeing bad economic growth, but we're seeing inflation going up? These are all signs that inflation is on the supply side. Everything else is on the demand side. Okay, so it's much easier. Can we trust a forecast published on Forex Factory? Cannot answer for Forex Factory, guys. It's not my job to answer about some other website. I can tell you that you can have a look at the forecast you can find on the Hot Forex economic calendar, and you can trust that it's been tested quite well. Any other questions? So feel free to ask again. So if you don't have any other questions, guys, so I'll just remind you of the Hot Forex app. So you can track everything on Forex and the markets. You can have a look at it. You can have it just in your on your mobile phone. And I'll remind you about the forthcoming webinar. So tomorrow, Otto will talk about money management strategies, which is quite important. We've got live analysis with Stuart on the coming week, and we've got technical analysis and how to trade the news on the coming week. One with Andrea, one with Otto, and you will find everything that's needed. So I will revert you to our analysis website, so analysis.hotforex.com. Sivmandia, I would also advise you to go to our analysis.hotforex.com. You will find everything you need on inflation. Just type inflation on the search button, and you will get every post we have on inflation, which is exactly what you will need to study after you can have a look at this video again. So we also, as you know, guys, we write lots of analysis, lots of educational material. You can just go to the analysis webpage, and everything is just the click of a button. Edward says that in some countries the economy is up to oil and its volatility. Yes, Edward, you are correct. So that depends on the country again. If we're talking about, South Africa, or sorry, Saudi Arabia, or Venezuela, or countries like that, then I agree with you. This is the economy is very dependent on oil and very volatile at times. But if we're talking about countries which are not dependent on oil for their growth, then we can understand how the oil price is going to affect the prices of the price level, i.e., if the inflation rate on that country. Can you get the best? Where can I get the best fundamental news on news that will affect the market and inflation? Sifamandla, the only answer I can give you that is that you need to watch the news. You need to, if you go to our analysis.hotforex.com, we also provide daily news. We've got every fundamental analysis you can get. Plus, we've got the very, very important economic calendar, guys. You need to have a look at the economic calendar, and you will find pretty much everything there. Any more questions, guys? So if not, then I will call this an end. And I really hope you have enjoyed this webinar. I really hope you've learned stuff. And if you have any questions, feel free to email us. Either myself, Andrea, or Stuart will get back to you the soonest possible. So thank you very much, Caleb, for your kind words. And I hope everyone enjoyed this webinar. Have a good trading day. And we will be back for more analysis, and log on to analysis.hotforex.com for more analysis on and educational stuff on any Forex trading pair. So thank you all for your kind words. I hope you enjoy. We will talk again very, very soon. Until then, take care and trade safely. Bye-bye.